Scott. Thanks so much for allowing me to be part of the podcast.
Most people speak on their throat.
I think you'd be a superstar in the banking industry.
We have not seen any dead bodies in the dumpster.
Tell us one of the dumbest, stupidest things you've ever done in your business career.
You have entered the world of accounting, the place where business dreams and financial reality collide into exciting things like journal entries, debits and credits, and financial statements. Everyday CPA Podcast, helping you and your business better compete, succeed, and win.
This is part one of a three-part series.
Greetings, this is Kelly Coughlin, CPA and CEO of Everyday CPA, providing tax, accounting, and revenue solutions to individuals and businesses throughout the U.S. In today's podcast, I'm going to interview a former grizzly bear. Yep, in a former life for 30 years, he was a grizzly bear who took the shape of an IRS officer, seizing assets and pursuing DOJ tax lien foreclosures. If you've done business with this man, that is, if you poke this bear, you probably were having a bad day. He is proof positive to my mantra that the IRS can be either a black bear or a grizzly bear, but regardless, a bear. And you know how to tell the difference between the two? If you climb a tree to escape, the black bear climbs up the tree to eat you. The grizzly bear simply rips the tree out by the roots and eats you. Regardless, don't poke the bear. David Ronquillo, did I say that name correct, David?
Yeah, Ronquillo.
David Ronquillo began his career as a revenue officer in 1980 in Seattle. He's held positions as Field Collection Group Manager and Senior Collection Policy Analyst. Currently, he's helping tax professionals increase their knowledge and skills representing clients who are dealing with the IRS collection operations. David, I want to welcome you to the Everyday CPA podcast and want to first ask you, in your past work, did you prefer climbing the tree or ripping the tree out by the roots?
Well, Kelly, I've never had it described that way as a grizzly bear, but it's certainly a lot easier to just simply rip the tree out by its roots, because you will bring down the taxpayer out of the tree to do what you need to do.
Well done. All right. So you prefer the rip the tree out method?
Yes. It's always more effective. We try to be effective when we were with the IRS.
So is it fair to say, David, that you have done your fair share of ripping the tree out?
Very much so, because the Austin district was one of the top districts in the country that did seizures, and my group happened to do a lot of them. So that's what we were focused on was, the enforcement and the collection. So yeah, there's a lot of trees that I ripped out.
Great. All right, let me just ask a handful of questions here, David, and if you want to go a certain direction, feel free.
Sure.
But I'm going to ask some questions that I think are kind of practical, real-life issues that taxpayers that have poked the bear, I suppose, that they have to deal with. Let's talk about LLCs, for instance. Does running your business revenues and expenses through a single member LLC offer the taxpayer, that single member, any protection from IRS collection?
Really, not to any great degree. The IRS, they have various procedures for dealing with LLCs, and I would always recommend to a tax practitioner, if his client is an LLC, to read the Internal Revenue Manual procedures. There are a number of pages to it as to how a revenue officer should be dealing with the LLC. The single member, it depends on what type of tax that is owed. Generally, what the IRS sees is that the LLC will have employees and they'll run up employment tax. Back in January of 2009, the IRS counsel came out with an opinion that effective after January 1st, 2009, that the trust fund recovery penalty would be used against the single member, against the individual, to collect the trust fund portion of employment tax. Prior to that, the IRS just said that the individual and the LLC were one and the same, and whereby the individual would have to pay the full amount of the employment tax, both the trust fund and the non-trust fund.
Well, that kind of applies to C Corps too. Is that the executive team, maybe not shareholders, but board members for employment tax, they look through to everybody for that, correct?
Exactly. With a C corporation, they'll look at the individuals that are responsible for making sure the employment tax was paid, and then who basically did nothing to see that it was paid. On a trust fund recovery penalty, there's two standards the IRS has to meet. One is responsibility, and the second is what's called willfulness. So was the individual responsible for ensuring that the employment tax was paid? And if they were, then were they willful? Did they know about the tax, and what did they do or not do to ensure that the tax was paid? So, and when you look at a business entity, corporation, or an LLC, the IRS is to look to all the individuals that may have had a place in dealing with the employment tax. So it doesn't necessarily have to be a corporate officer. It could be somebody that they just hired, the chief accountant, for example, who was responsible for making payments, paying the employment tax, making the FTDs. They could go after that individual. I like to use an example in my teaching, is that if you had two corporate officers, a president and a vice president, it was a construction company, and one of them spent, nearly 100% of their time in the field, managing construction projects. Even though they may be an officer, if they were not aware of the employment tax, or they really had no control over the funds, they would not be held liable for the trust fund recovery penalty. So,
okay. Well, the whole topic of employment tax is one almost a subject of a separate podcast, which we could focus on. But if we continue on that, let's say that you've outsourced, which many small businesses do. They outsource to, say, I'll mention some names, QuickBooks as being the top one, and then Gusto and a couple of these other ones that are in the payroll tax area. If you've outsourced it to them, how deep do you have to get into disbursement processes to get assurance that, let's just pick on QuickBooks, for instance, TurboTax, or Intuit, I should say, that they actually have made the distributions and payments of employment tax? Or once we outsource that, is it kind of not in the employer's risk category at this point?
The corporation or the individuals running the corporation, they cannot outsource the responsibility for making sure the employment tax is paid. What the IRS would expect them to do is that if a FTD is due on a Wednesday, that the officers, whoever's responsible for ensuring the employment tax to be paid, would check their bank statement or get some verification from QuickBooks, for example, that in fact the FTD was made. And if it's not made, then the expectation is that individual would take some action to contact QuickBooks in this example to find out, well, why didn't it get paid? If the company had money in the bank account, well, why wasn't it paid? So they can't outsource their responsibility.
All right. So they should go through one additional kind of review, monitoring to make sure that the funds came out of the account, which they most likely did. The question is, where did those funds go? And maybe check online to see if the FTD got paid and if there's any balance due. Maybe not every time, but once maybe the first couple times, every disbursement, but then maybe quarterly, you develop some procedures around that activity. Is that a fair statement?
Exactly right. Have some procedures developed to verify that if somebody else is making your FTDs, that in fact they are being made.
Okay. So that's enough on payroll. But my initial question was really not on employee tax. It was more about income tax due, because your question was, well, it depends on the type of, whether it be LLC, does it pierce through? So we agree that there really is no protection for anybody on the payroll tax thing. But on the income tax side, LLC versus not LLC, is there any protection in asset recovery from when you were in that business if the business activity and the tax liability was created by an LLC, single member LLC, versus just a Schedule C sole proprietor?
On an income tax situation where the individual owes just 1040 tax, well, the LLC is considered a separate entity from the individual. So any assets owned by the LLC are protected from any type of enforcement action by the IRS. What the individual has is an interest in that LLC. That's what he owns. So what the IRS would have to look at is what is the individual's personal assets. So, for example, as a resident, vehicles, bank accounts, personal, not LLC, but personal, okay? To get at the LLC, they would have to go after his member interest in that LLC. And that's for income tax.
Right. So if there's no financial assets in that LLC, let's say there's $10,000 tax due. There's no financial assets in there. There's only, property, plant, and equipment, or let's just say equipment. But the sole member has $100,000 in cash. Can they seek recovery from that $100,000 in cash?
If the $100,000 in cash is in the LLC's bank account,
it's in the individual.
Yeah, they can go after that. Yeah, if it's in their personal account, yeah, the IRS can go after that. LLC, regardless, they can go after that. The individual's personal bank account. It's got a bank account at Bank of America where he writes checks to pay the mortgage and pay for groceries. Yeah, the IRS can go after that.
What about if it's a dual member or more than one member LLC?
Then that gets a little bit more tricky, and quite frankly, I'd have to go back and read the rules on that.
Okay.
It's almost, they'd be filing a 1065, a partnership, and with a partnership, the general partners are equally liable for the debts of the partnership. But going the other way, the partnership is not liable for the debts of the individual if they owe 1040 tax. I'd have to go back and look at the IRM on that.
Okay. But you're saying when you would seek recovery from assets, it really didn't make any difference whether that was an LLC or a single member LLC or not. You would go to the owner of those assets regardless. Is that what you're saying?
Exactly. There are ways that the IRS can, if there's indicators of, not everything is being run above board, that the IRS can, go after the LLC or go after the individual. Okay.
Thank you so much, Kelly, for having me. I really appreciate it.
Kelly, thank you very much.
Thank you, Kelly. We'll talk soon.
Thanks for tuning in to the Everyday CPA podcast. We will see you next time.